Unit 5, Finance and Accounting, and this is chapter number 29 now. We are talking about costs. When we are talking about costs are the expenses incurred by a business. When we are talking about all these different types of costs, we are talking about various types of costs. The first one is variable cost. Variable cost is a cost which changes with the level of output, whereas a fixed cost is a cost which is independent of the level of output. When we are talking about variable cost, the examples are raw material and direct labor. And when we are talking about fixed costs, we are talking about all the expenses which are incurred by the business, which are completely independent of the level of output. Examples are rent and advertising and all the other costs which are not directly related to manufacturing or production of goods. After these two costs, we talk about cost which is called total cost. Sum of fixed and variable costs is called a total cost. After talking about total cost, we can now jump on to two other variations of cost, which are direct costs and indirect costs. Costs which can be traced back to or which can be identified with a particular product, project or department are called direct costs, and costs which cannot be traced back to or identified with a particular product, project or department are called indirect costs. Now most of the variable costs, they are going to fall under the category of direct costs, and most of the fixed costs are going to basically follow under the category of indirect costs. So fixed costs are mostly indirect costs and variable costs are mostly direct costs. Then we jump on to another variation of costs which is called marginal cost. Marginal cost is the cost of producing one extra unit of output. It basically includes all the variable costs because when an extra unit is being produced, we are not talking about the fixed cost because they remain the same irrespective of the level of output. So on production of extra units, we always incur variable costs, that is mostly direct material and direct labor. After that, we jump on to another type of cost, which is the last cost, that is going to be discussed under the scope of this chapter. We are going to talk about semi-variable costs. Now, we come across a lot of examples of these type of costs. These type of costs are the costs which are going to be, the landline bills, and then we are talking about the electricity bill, where we are going to have some variable element and some fixed element. For example, when we are talking about the electricity bill, it contains meter rent, and then it also contains the bill according to the consumption that has occurred in a particular month. So we are talking about semi-variable cost when a particular cost has a fixed element as well as a variable element associated with it. After that, we talk about a concept which is the core of this chapter. Basically, it is a break-even point. Break-even point is a point of no profit and no loss on break-even chart. A point of no profit or no loss on break-even chart is called break-even point. It may also be defined as a production level at which a business is able to equate its total revenues to its total costs. So a point of no profit or no loss on break-even chart is called a break-even point, or the production level at which the total revenues of a business equate its total expenses. Okay, after that we are going to talk about the advantages of break-even chart or break-even analysis. It is going to identify the fixed costs for us, which are going to be represented by a line which is parallel to x-axis, and then we are going to have total costs which are going to be identified through the break-even chart or through break-even analysis, and we are also going to be able to identify the variable costs. So three different costs can be identified through the break-even chart or through break-even analysis. If we can identify the costs, that is fixed, variable and total costs, obviously we can curtail them, we can reduce them, we can manage them more efficiently. So this is something which is going to help the business in efficient allocation of resources. Not only the costs are identified, but we are also able to identify the total revenue, the line which is made literally as a diagonal to both the axes, a line which is between the two axes, that is x and y axis, is going to be called total revenue. Total revenue is identified through break-even chart or through break-even analysis. So what can we do? Can we avoid opportunity cost of holding extra revenue? Obviously we can do that, and it also means that we can since we are able to identify the total revenue, we can also try to increase it as well. So total revenue is identified and opportunity cost is avoided, and we can manage things in a better way. We can actually do efficient allocation of resources as a result of that. Then now we are going to move on to other advantages as well. There's a concept which is called margin of safety. Margin of safety is the difference between actual sales or budgeted sales that are supposed to be there, and then the break-even point. So difference between actual sales and break-even point is what you call as, or budgeted sales and break-even point is what you call as margin of safety. It refers to the profitable units that are beyond the break-even point in a business. So when the production capacity goes beyond the break-even point, the excess capacity beyond the break-even point is referred to as margin of safety. So the margin of safety can be identified, and as a result of that, we can optimize our production process. We can produce, always in a profitable way, avoiding all the losses. Furthermore, apart from the margin of safety thing, we can also talk about, other things like identification of profits and identification of losses. Now, when profits are going to be identified, that is beyond the break-even point, the business will be able to manage the profits most efficiently since they have been identified ahead of time, and then the business will also be able to identify its losses and provide for them as a result of that. So a lot of advantages of break-even chart or break-even analysis. After that, we are going to jump on to limitations of break-even point. The limitations of break-even point or break-even analysis or break-even chart, whatever you call it, we are going to talk about a few limitations here. Now the limitations are basically, number one, we assume in break-even analysis that all the goods produced are completely sold and there is no concept of closing inventory, which is rarely the case. Then after that, we can also talk about a scenario, where another assumption is being made. The assumption is that fixed costs does not fluctuate, which is in conflict with the concept of economies of scale, because as the scale of operation increases, the fixed cost is bound to go down as a result of that. So yeah, we are creating an assumption which is in conflict with the concept of economies of scale. Furthermore, it does not take into account any qualitative aspects, business cycle changes, interest rate changes, and changes in inflation or deflation for that matter. All these things are not taken into account apart from the market conditions and government interventions. No qualitative aspects are taken into account when drawing the break-even chart. So these are also some limitations of break-even analysis. Finally, we are going to conclude this chapter with some numerical part. I told you that break-even point is a point of no profit and no loss. How do we calculate it? We calculate it through a break-even equation. The break-even equation is break-even point in units is equal to total fixed cost divided by contribution per unit. For calculating contribution per unit, we use the formula selling price per unit minus variable cost per unit. Then the formula for margin of safety, which is basically budgeted sales minus break-even point. Thank you very much. Assalamu alaikum.